Chapter 2: The Data of Macroeconomics. Let's begin with the most fundamental measure of economic activity: gross domestic product, GDP. GDP can be understood in two equivalent ways: total expenditure on domestically produced final goods and services, and total income earned by domestically located factors of production. Why are these two definitions equivalent? Because every dollar a buyer spends becomes income to a seller. This is a core principle in macroeconomics. Expenditure equals income. Let's revisit the circular flow diagram. It shows how households, firms, and markets interact, how spending flows generate income flows in the economy. To reflect a more realistic, open economy, we expand the model by including government collect taxes and spends on public goods and services, affecting both income and spending. Foreign sector introduces exports, an injection into domestic income, and imports, a leakage from domestic spending. This expanded circular flow captures the full picture of economic activity, connecting domestic production, government policy, and international trade. Additionally, it's important to understand what happens in the factor market. This is where households provide the inputs, called the factors of production, that firms need to produce goods and services. Each of these inputs earns a specific type of income. Labor earns wages, capital earns rental rate, land earns rent, entrepreneurship earns profit. Now let's talk about how we measure GDP, starting with the production approach, also known as the output approach. This method focuses on value added at each stage of production. What is value added? It is the difference between the value of output and the value of intermediate goods used to produce that output. In simple terms, it shows how much extra value is created at each stage of the production process. It allows us to measure the contribution of each activity or sector to the overall economy. Let's walk through an example. A farmer grows a bushel of wheat and sells it to a miller for $1. Farmer's value added is $1, no intermediate input. The miller grinds the wheat into flour and sells it to a baker for $3. Miller's value added is $2. That equals to $3 minus $1. The baker bakes a loaf of bread and sells it to an engineer for $6. Baker's value added is $3. That equals to $6 minus $3. The engineer eats the bread, so the total value added and therefore GDP is $6. That equals to $3 plus $2 plus $1. This example shows how GDP can be measured by summing the value added at each stage of production without double counting intermediate goods. Let's clarify an important distinction in economic measurement: the difference between stock and flow variables. A stock is a quantity measured at a specific point in time. A flow is a quantity measured per unit of time, such as per year or per month. For example, determine whether each is a stock or a flow. A household's wealth is a stock, versus its income and expenditure is a flow. The number of unemployed people is a stock, versus the number of people losing their jobs is a flow. The amount of capital in the economy is a stock, versus the amount of investment is a flow. The government debt is a stock, versus the government budget deficit is a flow. This distinction helps us interpret economic data correctly. Stocks reflects levels and flows reflect changes over time. Let's now clarify what exactly counts in GDP. GDP is the value of all final goods and services produced within a country during a specific period. We calculate GDP as the sum of value added at all stages of production. This is important because the value of final goods already includes the value of all intermediate goods used to produce them. If we counted both intermediate and final goods, we would be double counting, which would overstate the true value of production. Now, let's consider some special cases. Should these be included in GDP? Used goods? No, they were already counted when first sold as new. Inventories? Yes, they count as investment when produced, even if not yet sold. Intermediate goods? No, unless we're using the value-added method, which avoids double counting. Imputations? Yes. For example, estimated rental value of owner-occupied housing is included to reflect the service provided. Understanding what's included and excluded ensures that GDP reflects true economic output without overstating it. Here we look at the second method of measuring GDP, called the expenditure approach. This approach breaks GDP down into the total spending on final goods and services produced within an economy. We group this spending into four broad categories. Consumption, C, spending by households on goods and services. Investment, I, spending on capital goods, inventories, and new housing. Government purchases, G, government spending on goods and services, excluding transfers. Net exports, NX, that is, exports minus imports. Putting it all together, we have the national income accounting identity, that is, Y equal to C plus I plus G plus NX. Here Y represents GDP. This equation tells us that the total output equals total expenditure from households, firms, government, and the foreign sector. Let's break down all key components of GDP. Consumption, C, is the value of all goods and services purchased by households. It includes durable goods such as long-lasting items like cars, appliances, and furniture. Non-durable goods such as items with shorter lifespans like food, clothing, and fuel. Services such as activities like healthcare, education, entertainment, and transportation. You can click the link to look up personal consumption expenditures. Investment, I, refers to spending on capital goods, physical assets used in future production. It includes business fixed investment, such as spending by firms on equipment, structures, and intellectual property. Residential fixed investment, such as spending on new housing by households and landlords. Inventory investment, such as additions to firms' inventories of goods produced but not yet sold. You can click the link to look up gross private domestic investment. Here we continue with the remaining two components of GDP. Government purchases, G, represents spending on goods and services by federal, state, and local governments. This includes national defense, infrastructure investments like trains and subway rail installation, services provided by government employees, for example, public education, and policing. However, this excludes transfer payments such as Social Security, unemployment benefits, and welfare, since these are not payments for goods or services currently produced. You can click the link to look up federal government current expenditures. Net exports, NX, are the value of exports minus the value of imports. Exports are goods and services sold to other countries or foreign buyers. Imports are goods and services purchased from other countries or foreign producers. Net exports capture the net foreign demand for domestically produce goods and services. You can click the link to look up net exports of goods and services. Now let's examine the income approach, the third method used to measure GDP. This approach sums up all income earned by factors of production in the economy. National income, NI, is calculated as NI equals to compensation of employees plus proprietors' income plus rental income plus corporate profits plus net interest plus taxes on production and imports plus business current transfer payments. Net national product, NNP, adjusts for discrepancies in reporting and is given by NNP equals to NI plus statistical discrepancy. Gross national product, GNP, adds back depreciation, which is called consumption of fixed capital. GNP equals to NNP plus consumption of fixed capital. Gross domestic product, GDP, adjusts for factor income between countries. GDP equals to GNP plus factor payments from abroad minus factor payments to abroad. This method ensures that all income generated through production is properly accounted for in GDP. Let's now shift our focus from national aggregates to measures of individual household income, personal income, and disposable personal income. Personal income, PI, is derived from national income but adjusted for what individuals actually receive. PI equals to NI minus retained earnings minus indirect business taxes minus corporate income taxes minus social security taxes. Disposable personal income, DPI, is what households have left to spend or save after paying taxes and other compulsory payments. DPI equals to PI minus personal taxes minus non-tax payments. Notes on selected terms. Taxes on production and imports include excise taxes, sales taxes, and tariffs. Business current transfer payments include charitable contributions, fines and penalties, disaster relief funds. Net interest is the income households receive from government debt holdings. Consumption of fixed capital is the losses due to depreciations. Retained earnings are the profits kept by the corporations rather than paid to shareholders. Indirect business taxes include typically excise and sales taxes. Contributions for social insurance includes social security taxes. Income from transfer payments includes welfare benefits and social security payments. Non-tax payments includes fines, penalties, and traffic tickets. Let's take a moment to distinguish between two important ways to measure GDP, real GDP versus nominal GDP. Real GDP measures the value of goods and services using the prices from a base year. This allows us to isolate changes in output by removing the effects of inflation. Nominal GDP measures the value of goods and services using current prices from the year in which the output is produced. As a result, it reflects both changes in output and changes in prices. For example, refer to the table provided. Your task is to compute nominal GDP for each year using that year's prices and quantities. Compute a real GDP for each year using 2021 as the base year. This means using 2021 prices while applying the quantities from each respective year. Let's walk through how we compute the values in the GDP table for each year using 2021 as the base year. Nominal GDP is calculated using the prices and quantities from the same year. Let's compute nominal GDP for year 2022 as an example. So you take $31 times 1,000 plus $102 times 200, that equals to $51,400. Now allow you to compute nominal GDP for 2021 and 2023 using the same method. Once you finish, compare your results with the answer key provided. Real GDP is calculated by holding prices constant at base year levels, 2021 prices, and using current year quantities. This helps isolate the impact of quantity changes from price changes. Here is how we calculate real GDP for 2022. So you take $30 times 1,000 plus $100 times 200. That equals to $50,000. Again, I encourage you to calculate real GDP for 2021 and 2023. Use the 2021 prices but apply the quantities from those respective years. These steps help us separate the effects of output quantity from price changes, allowing us to better understand real economic growth over time. Now let's talk about how we measure changes in the overall price level using the GDP deflator and how we track inflation from one year to the next. What is the GDP deflator? The GDP deflator, also known as the implicit price deflator, measures the overall level of prices for all final goods and services included in GDP. It is calculated as GDP deflator equals to nominal GDP divided by real GDP times 100. This ratio tells us how much of the change in nominal GDP is due to changes in prices rather than changes in real output. How do we measure inflation using the GDP deflator? Inflation is the percentage change in the price level between two periods. Using the GDP deflator, the inflation rate is calculated as GDP deflator times 2 minus GDP deflator times 1 divided by GDP deflator times 1 and then times 100%. Let's compute the GDP deflators using values from our earlier example. GDP deflator for 2022, we take $51,400 divided by $50,000 times 100. That equals to 102.8. Now please calculate the GDP deflator for 2021 and 2023 using the same formula. Once you are done, compare your answers with the answer key. Now let's calculate the inflation rate between 2022 and 2023. So we take 112.12 minus 102.8 divided by 102.8 times 100%. That equals to 9.06%. I encourage you to try computing the inflation rate for the earlier year as well and verify your results with the solution key. These calculations help us separate changes in output from changes in prices and allow us to measure the inflationary pressure in an economy over time. Let's take a deeper look at how the GDP deflator functions as a weighted average of prices. The GDP deflator gives us an average of prices across all final goods and services. The weight on each goods price reflects that goods' relative importance in GDP based on quantities produced. These weights change over time, unlike a fixed weight index such as the CPI. Now suppose we have three goods indexed as 1, 2, and 3. PIT is the market price of good I in month T. QIT is the quantity of good I produced in month T. And GDPT is nominal GDP in month T. Or GDPT is real GDP in month T using base year prices. We compute the GDP deflator as GDP deflator T equals to nominal GDP T over real GDP T. That equals to P1T times Q1T plus P2T times Q2T plus P3T times Q3T over real GDP-T. Rewriting this in terms of weight, that equals to Q1T over real GDP-T overall times P1T plus Q2T over real GDP-T times P2T plus Q3T over real GDP-T times P3T. Letting WI as Q1T over real GDP T be the weight for each good. So GDP deflator T equals to W1 times P1T plus W2 times P2T plus W3 times P3T. So the GDP deflator is essentially a quantity weighted average of current prices with weights that shift as production patterns change. Let's examine how the growth rate of nominal GDP can be broken down into the sum of the growth rates of the price level and real output. We begin with the identity. Nominal GDP equals to P times Y, where P is the GDP deflator or price level and Y is real GDP. Taking the total differential, dPy equals to YDP plus PDY. Dividing both sides by PY, dPy over PY equals to YDP plus PDY over PY equals to dP over P plus dy over Y. This tells us percentage change in P times Y equals to percentage change in P plus percentage change in Y, or percentage change in nominal GDP equals to inflation rate plus percentage change in real GDP. For example, suppose year 1, real GDP 1 equals 100, GDP deflator 1 equals 2. Year 2, real GDP 2 equals 103. GDP deflator 2 equals 2.1. The question asks, find percentage change in nominal GDP. First, compute the percentage change in P, or the inflation rate. That equals 2.1 minus 2 over 2 times 100%, that equals 5%. Next, compute the percentage change in real GDP. That equals to 103 minus 100 over 100 times 100%. That equals to 3%. Therefore, percentage change in nominal GDP is approximately 5% plus 3% equals to 8%. Let's look at how to compute the percentage change of a ratio, specifically labor productivity, which is given by Y over L, where Y is real GDP and L is labor force. Taking the total differential, dy over L equals to L dy minus Y dL over L squared. Dividing both sides by Y over L, and after rearranging, dy over L over Y over L equals to dy over Y minus dL over L. This gives us the rule percentage change in Y over L equals to percentage change in Y minus percentage change in L. Equivalently, percentage change in labor productivity equals to percentage change in real GDP minus percentage change in labor force. For example, year 1, Y1 equals 100,000, L1 equals 100. Year 2, Y2 equals 110,000, L2 equals 103. The question asks, find the percentage change in labor productivity. First, calculate percentage change in real GDP. That is, percentage change in Y equals to 110,000 minus 100,000 over 100,000 times 100%. That equals to 10%. Then calculate percentage change in labor force. That is, percentage change in L equals to 103 minus 100 over 100 times 100%. That equals to 3%. Applying the formula, percentage change in Y over L equals to 10% minus 3%. That equals to 7%. So labor productivity increased by 7%. Let's look at a more refined way of measuring real GDP called chain-weighted real GDP. One issue with using a single base year for real GDP is that relative prices change over time. As a result, constant price GDP becomes less accurate the farther we get from the base year. Chain-weighted real GDP solves this by updating the base year every year. It calculates growth rates using successive years as the base years and links them or chains them together. Because of this continuous updating, chain-weighted GDP provides a more accurate measure of real output over time, especially when relative prices fluctuate significantly. This method is now the standard for national income accounting in most countries, including the US. Let's now turn to how we measure the cost of living using the Consumer Price Index, CPI. CPI measures the overall level of prices in the economy. Published by the Bureau of Labor Statistics, BLS, tracks changes in the typical household's cost of living. Used to adjust contracts and benefits through cost of living adjustments, COLAs, allows comparisons of dollar values over time by adjusting for inflation based on surveys that identify the typical basket of goods and services purchased by consumers. Every month, the BLS collects prices for each item in a basket and computes the total cost of the basket. Formula for CPI. CPI equals to cost of the basket in the current month divided by cost of the basket in the base period times 100. The CPI provides a practical way to monitor how the cost of living evolves over time, and it is widely used in economic and policy decision making. Example: suppose a typical consumer's basket consists of 20 pizzas and 10 records. For each year, we will compute the cost of the basket, the CPI, using 2020 as the base year, and the inflation rate from the preceding year. Let's walk through how we compute the cost of the basket, the CPI, and the inflation rate step by step. 1. Cost of the basket. To calculate the cost of the basket in any given year T, we multiply the quantity of each good by its price in that year. Example, for 2021, cost of the basket equals to 20 times $11 plus 10 times $15. That equals to $370. Please compute the cost of the basket for 2020, 2022, and 2023 using the same method. Once completed, compare your answers with the answer key. 2. CPI, using 2020 as the base year. Example for 2021, CPI equals to 370 divided by 350 times 100. That equals to 105.7. Now compute CPI for 2020, 2022, and 2023 using this formula. Check your work against the answer key when you are done. 3. Inflation rate. The inflation rate from year T1 to T2 is the percentage change in CPI. Example for 2022, inflation rate equals to 114.3 minus 105.7 divided by 105.7 times 100%. That equals to 8.11%. Try computing the inflation rates for 2021 and 2023. Once finished, compare your results with the answer key. These calculations help us track how the cost of living changes over time and how inflation affects purchasing power year by year. Let's take a closer look at the composition of the CPI's basket. This chart shows the categories of goods and services that make up the consumer basket used in the CPI calculation. As you can see, spending is distributed across housing, food, transportation, medical care, and more. The CPI is constructed as a weighted average of prices. That means each item in a basket is assigned a weight, which reflects how much a typical consumer's budget is spent on that item. For example, if housing takes up about 44% of a typical household budget, then housing prices have a large influence on the CPI. These weights are based on consumer surveys and remain fixed over time, which is why the CPI is called a fixed weight price index. This fixed weight design allows us to track changes in the cost of living, assuming the consumer buys the same basket of goods year after year. Let's break down how the CPI is computed and how it compares to the GDP deflator. Assume we have 3 goods indexed as 1, 2, and 3. CI is quantity of good I in the CPI fixed basket. PIT is price of good I in month T. ET is cost of the CPI basket in month T. EB is the cost of the CPI basket in the base period. So CPI formula is CPIT equals to ET over EB. That equals to P1T times C1 plus P2T times C2 plus P3T times C3 over EB. That also equal to C1 over EB overall times P1T plus C2 over EB overall times P2T plus C3 over EB overall times P3T. That equals to W1 times P1T plus W2 times P2T plus W3 times P3T. This shows the CPI as a weighted average of prices, where the weights WI are based on the fixed basket. CPI versus GDP deflator. The key differences. Capital goods included in GDP deflator is produced domestically but excluded from CPI. Imported consumer goods included in CPI but excluded from GDP deflator. Basket of goods. CPI uses a fixed basket. GDP deflator uses a changing basket, which is chain weighted. Let's explore two additional concepts, the PCE deflator and core inflation, and how they relate to CPI and the GDP deflator. CPI and GDP deflator versus PCE deflator. The personal consumption expenditures PCE deflator is the ratio of nominal to real consumer spending. The Federal Reserve prefers the PCE deflator when targeting inflation due to its broader and more flexible coverage. How the PCE is like the CPI. PCE only includes consumer spending. CPI includes imported consumer goods. How the PCE is like the GDP deflator. Both use a changing basket of goods and services rather than a fixed one. Core inflation. It is a measure of inflation that excludes food and energy prices, which tend to be more volatile. Core inflation provides a clearer view of the underlying inflation trend. It is reported in two forms, core CPI and core PCE. These tools help policymakers and economists better access inflation dynamics in both the short and long run. Let's consider some key reasons why the CPI may overstate the true rise in the cost of living. Substitution bias. The CPI uses fixed weights based on a predetermined basket of goods. It does not account for consumers substituting away from goods that become relatively more expensive and toward those that become cheaper. Introduction of new goods. New goods increase consumer choices and enhance well-being, effectively raising the real value of money. However, because the CPI basket is fixed, these benefits are not immediately reflected in the index. Unmeasured changes in quality. Improvements in product qualities increase the utility of goods even if their prices stay the same or rise slightly. If these quality changes are not fully accounted for, the CPI will misinterpret price increases as inflation. Cost of living versus CPI. A perfect cost of living index would fall or rise less rapidly when newer and better goods reduce actual living costs. The CPI does not fully adjust for such dynamic improvements, leading to potential overstatement. As a result, the CPI may report a higher inflation rate than what consumers actually experience in terms of cost of living adjustments. Let's now turn to how we measure joblessness in the economy starting with the unemployment rate. The Bureau of Labor Statistics, BLS, conducts a monthly survey of approximately 60,000 households, representing around 110,000 individuals, targeting adults aged 16 or older. Each individual is classified into one of three categories: employed, working at a paid job, including part-time or full-time; unemployed, not employed but actively looking for a job in the previous 4 weeks; not in the labor force, neither working nor actively looking for work. For example, retirees, full-time students, stay-at-home parents. And the labor force, that equals to the number of employed plus the number of unemployed. This figure represents the total supply of labor available to produce goods and services in the economy. The three groups of the populations are the number of employed, the number of unemployed, and the number of not in labor force. To understand the labor market, we rely on two important statistics: the unemployment rate and the labor force participation rate. Unemployment rate. This is the percentage of the labor force that is unemployed, people who are not working but are actively seeking employment. Unemployment rate equals to number of unemployed divided by labor force times 100%. Labor force participation rate. This measures the share of the adult population that is in the labor force, either working or looking for work. Labor force participation rate equals to labor force divided by adult populations times 100%. These metrics help us assess the health of the labor market and the extent to which people are engaged in economic activity. Let's walk through a real-world example of how to calculate key labor market indicators. Given number of people employed equals 160.1 million, number of people unemployed equals 5.7 million, adult population equals 264 million. To find the labor force, we add the number of employed and unemployed individuals. Labor force equals to 160.1 plus 5.7 equals to 165.8 million. This tells us how many people are actively participating in the labor market, either working or seeking work. Next, we calculate the percentage of the labor force that is unemployed. Unemployment rate equals to 5.7 divided by 165.8 times 100%, that equals to 3.4%. So about 3.4% of the labor force was unemployed in January 2023. Finally, we calculate what fraction of the adult population is in the labor force. That is labor force participation rate, that equals to 165.8 divided by 264 times 100%, that equals to 62.8%. This means that about 62.8% of the adult population was either working or actively looking for work. Let's walk through another example that asks us to calculate changes in labor market indicators using percentage changes. Suppose the following changes occur. The total population increases by 1%, the labor force increases by 3%, the number of unemployed persons increases by 2%. Now we are asked to compute the percentage changes in labor force participation rate and unemployment rate. For labor force participation rate, recall the formula. Labor force participation rate equals to labor force divided by adult populations. So the percentage change in labor force participation rate equals to percentage change in labor force minus percentage change in adult populations. Substitutes the values. Percentage change in labor force participation rate equals to 3% minus 1% equals to 2%. So the labor force participation rate increases by 2%. For the unemployment rate, recall the formula: unemployment rate equals to unemployed divided by labor force. So the percentage change in unemployment rate equals to percentage change in unemployed minus percentage change in labor force. Substitute the values: percentage change in unemployment rate equals to 2% minus 3% equals negative 1%. So the unemployment rate actually decreases by 1%. Let's take a moment to test your understanding with a few quick questions. This will help reinforce some key concepts we've covered. Question number 1. What GDP measures the value of the economy's output at current prices and is a what variable? Nominal GDP is measured at current prices and represents a flow variable. It is calculated over a period of time. So the answer is B. It is nominal GDP and a flow variable. Question number 2. The Ford Motor Company makes a car in 2023 and sells it to the Jackson family in 2024. This event increases what? The car counts as inventory in 2023, which increases GDP then. When sold in 2024, it counts as consumption, but it doesn't count again in GDP since it was already included. So the answer is D. Consumption in 2024 and GDP in 2023. Question number 3. If nominal GDP and real GDP both rise by 10%, the GDP deflator will do what? The GDP deflator is the ratio of nominal to real GDP. If both rise by the same percentage, the GDP deflator remains unchanged. So the answer is D. To wrap up this chapter, we explore the key measures of economic performance: GDP, CPI, and unemployment rate, and how they are constructed and interpreted. We examine the differences between nominal and real variables, how inflation is tracked using indices like the CPI, GDP deflator, and PCE deflator, and why CPI may overstate the cost of living. We also reviewed how the labor market is measured, including concepts like labor force participation and unemployment, and practice calculating them with real data. Understanding these core indicators provides a solid foundation for analyzing macroeconomic trends and evaluating policy impacts.